What if I told you that the 2008 financial crisis wasn't a failure of the system, but the system working exactly as designed? Here's the pattern you're not supposed to see. Every 30 to 40 years for the past 3 centuries, the exact same financial playbook gets run. Credit expands, assets inflate, the middle class borrows, and then, right on schedule, the rug gets pulled. Wealth consolidates upward. The rich buy everything at pennies on the dollar, and the cycle resets. You feel it, don't you? Your rent's up 40% since 2020. Your groceries cost double. You're working harder than your parents did, yet you can't afford a home they bought on a single income. You think that's organic market forces? It's not. It's the inheritance of a 300-year-old banking blueprint that turned money itself into a weapon. The 2008 crash? Scripted. The 2020 money printing? Scripted. The next collapse you feel coming? Already written. And the architects? They've been running this con since 1694. Same families, same institutions, different logos. So before we go deeper, drop a comment below. Where are you watching from? Because this conversation is global, and the more people who see this pattern, the harder it is for them to run it again. Hit that subscribe button if you're done with the official story. We're about to show you the receipt, because the American economy isn't broken. It's functioning exactly as its designers intended, and once you see it, you can't unsee it. Let's start at the beginning. In 1694, the British crown was drowning in war debt. King William III needed $1.2 million, an astronomical sum, to fight France. The Goldsmith bankers of London saw an opportunity. They proposed a radical deal. We'll loan you the money, but in exchange, you give us a charter to create the Bank of England, the first modern central bank. And here's the kicker. We get to issue currency as debt, meaning every pound entering circulation would be loaned into existence, with interest. The king agreed. The bankers won. And the greatest financial scam in history was born. Here's what they engineered. A system where the nation's money supply wasn't created by the government, but borrowed from private bankers who created it out of thin air. The public got currency, the bankers got collateral, bonds, land, taxes, real assets in exchange for paper promises. Sound familiar? Fast forward to 1913. The United States, after killing 2 previous attempts at a central bank, secretly passed the Federal Reserve Act on December 23rd, right before Christmas recess, when most of Congress had left town. A private consortium of banks was granted the power to issue U.S. dollars as debt. The same blueprint, the same con. Today, the Federal Reserve isn't federal, and there are no reserves. It's a private banking cartel with a government logo. Every dollar in your wallet is a Federal Reserve note, an IOU created through debt issuance. The U.S. government doesn't print money. It borrows it from private banks at interest, forever. Sound familiar? Now let's talk about what happened next in Britain. The early 1700s saw an explosion of speculative finance. The South Sea Company, granted monopoly trade rights, became the hottest investment in Europe. Its stock price soared 1,000% in months. Everyone, from dukes to servants, leveraged themselves to buy in. The directors took secret loans from the company itself to buy more shares, creating artificial demand. It was the world's first pump and dump scheme. In 1720, it collapsed. The South Sea bubble burst. Fortunes evaporated overnight. Suicides spiked. The middle class was ruined. And the insiders? They'd sold at the top. They bought estates, land, and distressed assets at liquidation prices. Wealth transferred from the many to the few in a single orchestrated crash. Sound familiar? Let's jump to America. The Roaring '20s. Credit was everywhere. Margin loans let ordinary people buy stocks with just 10% down. The Federal Reserve kept interest rates artificially low, pumping money into the economy. Stock prices went parabolic. Everyone felt rich. Then, in 1929, the Fed suddenly reversed course, raised rates, and contracted the money supply. The market crashed. Banks failed. Unemployment hit 25%. And while Main Street starved, J.P. Morgan and the Rockefellers bought railroads, real estate, and entire industries for cents on the dollar. The Great Depression wasn't a natural disaster. It was a controlled demolition with a buyer waiting at the bottom. Sound familiar? Now let's fast forward to 2008. For 2 decades, the Federal Reserve kept interest rates near zero, flooding the economy with cheap debt. Banks handed out subprime mortgages like candy. Wall Street bundled those toxic loans into mortgage-backed securities, slapped A ratings on them, and sold them worldwide. Housing prices soared. Everyone felt like a real estate mogul. Debt was repackaged as wealth. Then the Fed raised rates. The music stopped. The housing market collapsed. Lehman Brothers fell. The global financial system teetered. And the response? A $700 billion bailout. Not for you, for the banks that engineered it. They got rescued. You got foreclosed. Meanwhile, BlackRock, J.P. Morgan, and private equity firms swept in and bought millions of distressed homes at fire sale prices. They turned the American dream into a rental economy. Today, Institutional investors own a record share of U.S. housing. You're not priced out by accident. You're priced out by design. Sound familiar? See the pattern now? It's not a coincidence. It's not bad luck. It's not even incompetence. It's a system that works in cycles, expand credit, inflate assets, seduce the public into debt, contract the money supply, trigger collapse, and consolidate wealth at the bottom. Every generation gets fleeced, and every generation believes it's the first time. But here's the part that should terrify you. This isn't just history, it's the operational manual. So how do they actually pull this off? What's the mechanism that lets a small group of bankers orchestrate collapse after collapse without anyone stopping them? The answer is breathtakingly simple. Fractional reserve banking combined with central bank control of the money supply. Here's the dirty secret. When you deposit $1,000 in a bank, you think that money is sitting there, safe in a vault. It's not. The bank is legally allowed to keep only a fraction, historically 10%, now effectively 0% since 2020, and loan out the rest. That loaned money gets deposited elsewhere, and that bank loans out 90% again. $1,000 of real money becomes $10,000, then $100,000 in circulating credit through this multiplier effect. Money is being created out of nothing by private banks for profit. But here's where it gets darker. The banks don't lend their own money. They lend your future labor. Every loan is a claim on your future income. When you take a mortgage, you're promising 30 years of your life to pay back money that didn't exist until you signed the paperwork. The bank gave you numbers on a screen. You give them 3 decades of work. That's not lending. That's indentured servitude with a credit score. Now layer in the central bank. The Federal Reserve controls how much credit flows into the system. When they want growth, they lower interest rates and buy bonds, injecting liquidity, making borrowing cheap. Asset prices rise, everyone feels wealthy, debt explodes. Then, when they want to cool the economy, they raise rates and tighten lending standards. Credit dries up, borrowers default. Asset prices crash, and those who position themselves in cash or treasuries during the boom sweep in and buy real assets, factories, homes, land, at depression prices. The Federal Reserve isn't fighting inflation or unemployment, it's conducting controlled detonations. And the people running this machine, they have a name, a network, a 3-century-old pedigree of financial engineering that most people have never heard of. The dynasty that whispered in the king's ear in 1694 is still whispering in the Treasury Secretary's ear today. You won't believe the name, but the receipt is wilder than you think. Let's go deeper. Let's break this machine down piece by piece so you understand exactly how the illusion works and why collapse is baked into the system. Mechanism 1. Debt-based currency and the interest trap. Every dollar that enters the economy is created as a loan. The Federal Reserve doesn't print money and hand it out. It loans money into existence by purchasing government bonds. The U.S. Treasury issues a bond, a promise to repay with interest, and the Fed buys it by crediting the Treasury's account with new money. That money didn't exist before. It's conjured. Digital keystrokes. Now here's the mathematical impossibility. If all money is loaned into existence with interest attached, where does the money to pay the interest come from? It doesn't exist. It has to be borrowed into existence too, which creates more debt, which requires more interest payments, which requires more borrowing. It's an infinite loop, a Ponzi scheme where the base layer is the money supply itself. The U.S. national debt in 1913, the year the Fed was founded, $2.9 billion today, over $36 trillion. That's not mismanagement. That's the system functioning as designed. The debt can never be repaid. It's not supposed to be. The interest payments are the point. They're the tribute, the permanent tithe to the financial class. Consider this. In 2024, the U.S. government will pay over $1.2 trillion just in interest on the national debt. Not building roads, not funding healthcare, just interest. That's more than the defense budget. That's wealth extraction on a civilizational scale. And where does that money go? To bondholders, the largest of which are private banks, foreign central banks, and financial institutions. You're working to pay interest on money that was created from nothing. Mechanism 2, fractional reserve lending and the credit multiplier. Let's say you deposit $10,000 in Bank A. That bank is required to keep 10% in reserve, historically. Today it's literally 0, but let's use 10% for clarity. So they keep $1,000 and loan out $9,000 to someone buying a car. That person's $9,000 gets deposited in Bank B. Bank B keeps $900 and loans out $8,100. That gets deposited in Bank C, which keeps $810 and loans out $7,190. Your original $10,000 has now become $24,390 in circulating money. And the chain continues. By the time the multiplier effect runs its course, that initial $10,000 can theoretically create $100,000 in credit. But here's the kicker. That $100,000 isn't real. It's not backed by anything. It's just ledger entries, promises, IOUs stacked on top of each other. And every single one of those dollars is a claim on someone's future labor. When the chain breaks, when borrowers can't pay, the entire structure collapses. This is what happened in 2008. Banks had leveraged themselves 30 to 1 or even 50 to 1. For every dollar of actual capital, they'd created $30, $50 in synthetic credit. When defaults started, the whole multiplier ran in reverse. Credit evaporated. And with it, trillions in perceived wealth. But the debt remained. You still owed your mortgage. The bank just didn't have to pay its bets. Mechanism 3. Asset inflation and engineered crashes. Here's where the cycles get weaponized. When central banks flood the system with cheap credit, that money doesn't go into wages or productivity. It goes into assets, stocks, real estate, bonds. The wealthy, who have access to leverage and insider information, front-run the inflation. They borrow cheap, buy assets, and ride the wave up. Between 2008 and 2021, the Federal Reserve printed over $8 trillion through quantitative easing. Where did it go? The S&P 500 tripled. Housing prices soared 50-80% in many markets. Billionaire wealth doubled. But median wages? They grew 2 to 3% annually, barely ahead of inflation. The bottom 50% of Americans own 2% of the nation's wealth. The top 1% owns 32%. And that gap isn't shrinking, it's accelerating. Because the system isn't broken, it's working exactly as designed. Now here's the engineered part. When asset prices get too frothy, when speculation becomes obvious, central banks raise interest rates. They call it cooling the economy. And what they're really doing is triggering a deleveraging event. Borrowers who took on cheap debt suddenly can't afford payments. Defaults spike, assets get liquidated, prices collapse. And who's waiting at the bottom? The same insiders who sold at the top. They're sitting on cash, treasuries, and liquidity. They buy distressed assets at 30, 50 cents on the dollar. Wealth transfers in one orchestrated crash. The 2008 crisis transferred an estimated $16 trillion in household wealth from the middle class to financial institutions and investors. That's not a bailout. That's a heist with legal paperwork. Mechanism 4. Moral hazard and the bailout guarantee. Here's the final piece of the scam, the implicit guarantee that the banking elite will never be allowed to fail. In 2008, Lehman Brothers collapsed. Bear Stearns collapsed. Washington Mutual, the largest bank failure in U.S. history, collapsed. And the response from the government? Bailouts. $700 billion in the TARP program, trillions more in Federal Reserve loans, swaps, and asset purchases that were kept secret for years. The banks that caused the crisis were rescued. Not one major executive went to jail. Not one. Meanwhile, 10 million Americans lost their homes. But the message was clear. If you're too big to fail, you're too big to prosecute. The system protects its architects. This is moral hazard on a systemic level. When risk is privatized, banks keep the profits, but losses are socialized, taxpayers cover the failures. You've created a financial system that rewards reckless gambling. Why wouldn't banks take insane risks? They get the upside, and we get the bill. And it's happening again, right now. In 2023, Silicon Valley Bank and Signature Bank collapsed. First Republic failed. The government and Fed stepped in with emergency measures, guaranteeing deposits beyond FDIC limits and opening lending facilities. The message? We'll print whatever it takes to save the system. But the system isn't you, it's them. Mechanism 5. The shadow banking system and derivatives time bomb. Now let's talk about the part of the financial system you can't see, the shadow banking sector. Traditional banks are regulated. They have capital requirements, stress tests, oversight. But shadow banks, hedge funds, private equity, investment banks, special purpose vehicles operate in the dark. They use derivatives, rehypothecation, and off-balance sheet leverage to create synthetic credit that dwarfs the traditional banking system. The global derivatives market is estimated at over $600 trillion. Let me repeat that. $600 trillion, that's nearly 10 times global GDP. These are bets on bets on bets, swaps, options, futures, collateralized debt obligations. And they're interconnected. One default can cascade through the entire system. In 2008, AIG, a single insurance company, had written so many credit default swaps, insurance on bad debt, that its collapse threatened the entire global financial system. The government gave AIG $182 billion to prevent a chain reaction. But the derivatives market is exponentially larger now, and it's even more interconnected. The next crisis won't just be mortgages, it'll be sovereign debt, corporate bonds, commercial real estate, and a derivatives implosion that makes 2008 look like a practice run. And when it comes, not if, but when, the same playbook will be used. Print money, bail out the banks, let the public eat inflation. The pattern is undeniable. Look at the timeline, 1720, South Sea bubble. Insiders sell, public loses, wealth consolidates. 1797, Bank of England suspends gold payments, devalues pound, profits from Napoleonic Wars. 1825, British banking crisis. Loans collapse, banks fail, assets seized. 1837, U.S. panic. Andrew Jackson kills the second bank. Banks crash, depression follows. 1873, Long Depression. Railroads collapse, silver demonetized, wealth concentrates. 1907, bankers panic. J.P. Morgan orchestrates bailout, pushes for Federal Reserve. 1929, Great Depression. Fed contracts money, market crashes, industrialists buy America. 1987, Black Monday. Algorithmic crash, insiders profit from volatility. 2000, dot-com bubble, speculative mania, insiders sell, retail loses trillions. 2008, housing crash, subprime explosion, banks bailed out, assets consolidated. 2020, COVID crash, fastest market drop in history, fastest recovery for the rich, $5 trillion printed, every 30 to 40 years, like clockwork. This isn't conspiracy theory. It's observable pattern. It's historical record. And it's operational doctrine. The machine runs on credit expansion, speculative mania, deliberate contraction, and wealth transfer during collapse. It's parasitic finance. And you're the host, so here's where we are. The system that bled Britain in 1720 was imported to America in 1913. The same families, the same playbook, the same engineered cycles of boom, bust, and wealth extraction. And every collapse leaves the public poorer and the banking elite richer. But here's what should keep you up at night. The next cycle is already in motion. And it's going to be faster, bigger, and more devastating than anything we've seen before. Why? Because the system is global now. The debts are bigger. The derivatives are more interconnected. And the money printing, quantitative easing, stimulus packages, bailouts, has reached a terminal stage. We're $36 trillion in debt as a nation. Japan is at 264% debt to GDP. The European Union is imploding under austerity and energy crisis. China's real estate sector is collapsing. The central banks have one move left: print more. And when they do, the currency itself collapses. Not just your purchasing power, the dollar's reserve status, the bond market, the illusion of stability. And when it breaks, when the everything bubble finally pops, there will be no bailout big enough. The math doesn't work anymore. The only question is, will you see it coming? This is your final warning. The system isn't broken. It's functioning as designed. A 300-year pattern of greed, illusion, moral hazard, and parasitic finance that turns money into a weapon and debt into chains. You can deny it, you can hope it's wrong, or you can prepare. So I'll leave you with this. Are we wiser now, or are we just walking the same path in better suits? Drop your thoughts below. Share this with someone who needs to see it. And if you're done with the official story, hit that subscribe button, because the truth isn't coming from the institutions built on borrowed time. It's coming from people who refuse to look away. The collapse is coming. The only question is whether you'll see it before it sees you.